be half of what the sell-side bank earns as a fee on a transaction. Let's talk a little bit about SEC filings. If you're going to work in banking or if you're going to work in private equity, if you're ever going to analyze public companies, and as part of the valuation exercise you probably will, chances are you're going to have to work with SEC filings. What's the SEC? Securities and Exchange Commission, basically the regulatory body for the U.S. equity and basically for the public markets in the U.S. If a company has public equity or if it has publicly traded debt, they're required to file certain types of SEC filings on a regular basis with the Securities and Exchange Commission so that they can disclose their financial condition, they can disclose key events in their business to the public, to the folks who might hold or might have an interest in holding those securities. Okay? These filings will contain all different types of information. Sometimes they might just contain financial statements, notes to the financials, that type of thing. Sometimes it'll be really just geared toward addressing or announcing material events in the business. We'll go through all the different types of SEC filings in a moment, when and why you would use them. Okay, if you're looking for financials on a company, and that's typically what you're going to be doing when you're looking at SEC filings. They're really easy to find on the SEC website. You go to sec.gov. There's a link to what they call their EDGAR database, EDGAR, and then you can click on another link that says, I think, search company filings. You can search on keywords. You can enter their ticker symbol if you have it. You can enter their SIC code, different types of things. All right. And if you're looking at companies that are domiciled in other countries, you'll probably have to go to those countries' version of the SEC. Now, this is really important. If you're working in banking or private equity, if you're looking at a public company, always get your data from the SEC. Okay, you can get data from other sources. You can get data from Yahoo Finance or Bloomberg or a lot of those different content aggregators. All right, but you always want to source your data directly from the SEC. Yahoo and some of those other folks, they might actually combine some numbers or make some adjustments to the numbers that they don't footnote, they don't tell you about. Right? And so by taking numbers from Yahoo, you might not be getting the full picture. So always, if you're looking at a public company, always get their information from the SEC. Right? One reason for that, SEC filings are written by management, they're reviewed by management, they're also signed off on by management such that they can be personally liable if there's some element of fraud that's proven in the financials. That's part of Sarbanes-Oxley, one of the many things that came out of Sarbanes-Oxley. All right, if you're ever going to work in banking or private equity, you really need to get good with looking at these statements. Okay? And I actually have given you, as part of the handouts, you've got a 10K for Heinz, which we'll go through in a little while. You've also got a 10Q for Heinz. You're going to use those for your homework tonight. So you're going to get some practice tonight, and then you'll get more practice for tomorrow night's homework when we start talking about valuation. Let's talk a little bit about the different types of filings you'll see. This is not a comprehensive list. There are definitely more types. These are really the ones that you'll probably see most often in banking, private equity, et cetera. All right, so in S1, this is what they call a registration statement. This gets filed when a company first decides it wants to go public. All right, so when they decide they want to go public, they probably are hiring an equity capital markets bank or equity capital markets banker to help them with that process. One step along the way is going to be to help the company get its S1 ready, get it filed with the SEC, address any comments the SEC has on that. Usually a back and forth process that can take several months, in my experience. But it's a really, really good, detailed source of information on the company. It'll give a very detailed overview of their business, how they market and sell their products. Sometimes they'll talk about customers. Okay. Sometimes they'll talk about where they're doing business, store counts if it's a retailer, all different aspects of that company's business. In S2, you might run across really kind of slimmed down version of the S1, allows incorporation by reference of key docs. All right. Typically, if you have an S1 and an S2, S1 is probably better to focus on because it's more comprehensive. S4, just registration of public securities, typically stock. in connection with an M&A or an exchange offer. Okay, so a company decides to buy another company. They decide that they want to pay for that by issuing stock. If they haven't already registered it, they're going to have to file an S-4 to register that stock with the SEC before they can issue that. And probably the most common types of filings you will run across are what we call a 10K and a 10Q. Okay, these are filed on a periodic basis. 10K is filed once a year. It's basically the company's annual results. It's kind of like their annual report. In the very beginning of that, it'll give a big detailed overview of their business, kind of like the S1 does, right? But it gets updated over time. Right? And then there'll be the financials for that entire year that's being covered for the company's fiscal year. Most companies operate on what we call a calendar fiscal. So their fiscal year ends December 31st. So by basically the end of February, they need to file a 10K with the SEC with their financial statements. These financial statements in the 10K are audited. So a firm like Deloitte might come in and provide an audit, really testing the validity of those statements, making sure the accounting processes are correct. And then for the other 3 quarter ends throughout the year, a company with a calendar fiscal, they would file 3 10Qs, one after their March 31st quarter, one after their June 30th, one after their September 30th, need to be filed within 30 days of the end of the quarter. And we use these to help provide us a year-to-date assessment of the company's finances. All right? I'm going to show you how we use a 10Q a little bit later. All right? The other thing I'll point out, difference between the 10K and the 10Q, 10Q is not required to be audited. All right? It's typically just put together. Then the financials, again, get audited once a year as part of the process of getting the 10K filed. Some other filings you might see, an 8K, unlike a 10K or a 10Q, which again gets filed at regular intervals throughout the year, an 8K is only going to get filed upon the occurrence of a material event in the company's business. All right, they decide to sell the company, they decide to buy another company, they decide to sell a division, all right, they fire or hire a new CEO, okay, they enter into a big financing agreement with a bank. There are a bunch of different quote-unquote material events that would require the company to file an 8K. These are especially useful if we're looking at precedent transactions, which we're going to do starting tomorrow, and gives us a sense of the terms of a deal, helps us validate a lot of those terms. Okay. And then if you see a filing with an A at the end of it, not just an 8KA, but a 10KA, a 10QA, that A means that the financial statement or that filing has been amended. All right. In the case of financial statements, they might have gone back and amended some of the accounting, or in the case of an 8KA, sometimes some of the deal terms might have changed, and they would go back and file an amendment to that original filing. 11K, probably won't need to see a lot of 11Ks. It's kind of like an annual report, but it's really more specific to an employee stock purchase plan or an employee stock ownership, an ESOP plan, one of those types of things. All right. Now, all the filings we've talked about so far are filings that the company itself files about itself. Financial statements, the 8K, et cetera. The next 2 filings we talk about, a 13D and a 13G, these are actually filed by outside investors in the company. Really meant to disclose beneficial ownership over and above a 5% threshold. So if we acquire 5% or more of the stock of a publicly traded company, we're required to file either a 13D or a 13G based on what our intentions are. If we intend to be activist investors, okay, you think about Carl Icahn again, he probably files a lot of 13Ds. He acquires a material position, usually above that 5%, takes a board seat, exhibits significant control. He's an activist investor. He would file that 13D. Has to be filed within 10 days of the acquisition of those shares or within 10 days of when they go over and above the 5% threshold. And then the 13G, same threshold, 5%, but this is meant to disclose ownership by a passive investor, maybe a mutual fund. Mutual fund just really likes IBM stock, so they buy 6% of it. All right? But they don't intend to take a board seat. They're not accumulating that stock to try and make an offer for the company or a hostile bid. Just going to be a passive investor. All right, so 13D, 13G filed by outsiders. And then finally, the definitive 14A, also known as the proxy statement. This is filed by the company, usually to announce a shareholder meeting and to talk about items on which the shareholders are going to vote. All right, board and management changes, compensation. If the company's gotten a bid to sell the company, then there might be a vote, and that 14A would be filed to announce that. When is the vote going to take place? What are the options that shareholders can vote on? That type of thing. All right, again, not all of the SEC filings that are out there, but probably 99.9% of what you'll see or need to work with if you work in banking or private equity. Any other questions on these? So let's talk a little bit about a 10K. All right, we've got a 10K in front of us, that Heinz financial statement with the ketchup bottle and stuff on the front. 10Ks, again, filed once a year, and this needs to be updated within 60 days after the close of the company's fiscal year end, and really separated into 4 main sections. And the Heinz one is, I think, a little differently organized, but in terms of its order, but all these sections are in there. Okay, so typically it'll start out with a general business overview. That is, what do we do? How do we generate revenues? How do we, kind of earn a living, so to speak? In the case of Heinz, we sell ketchup and other condiments, other food packaging, or other food products. We sell them internationally. Our customers include probably grocery stores or just food distributors. Okay, if we have any customer concentrations, sometimes those get noted. If we have facilities around the world, that type of thing. We'll also talk about sometimes who are our competitors. And that can be really useful when we're selecting comparable companies, because we can look at the competition section of a 10K and figure that if they compete directly with them, those companies should probably be comparable for valuation purposes as well. All right, we'll come back to that. Just something I wanted to note. We'll talk a lot more about that tomorrow. But they might talk about suppliers, sales and marketing, any regulations affecting that particular industry, legal issues, risks, etc. All right, just a very comprehensive overview of the company's business. In the case of Heinz, you probably know what they do, but a lot of times you'll be dealing with companies you've never heard of before. All right, a publicly traded rope manufacturer, and that's where you'll find out a lot of information on them. Usually what will follow the overview section is something we call the MD&A, or Management's Discussion and Analysis section. This is where the management team tells us what's going on financially with the business, what's happened during the last year of the business, what's happened to our revenues. Are they up? Are they down? Why are they up? Why are they down? Okay, what's happened to our costs? What's happened to our liquidity? There'll usually be a section on liquidity there, talking about how much cash does the company have, how much availability do they have under lines of credit, that type of thing. Okay, this is it's also a great source for something that we're going to talk about later, non-recurring charges. Things that happened during the year that were one-time events that we would not expect to occur every year going forward. All right, so to the extent the company has those things, it'll usually be talked about in the MD&A section. It'll talk about how much it was. It'll talk about whether it was an unusual expense or maybe an unusual gain. Okay, we'll come back to that in a little while. All right, but this is really important. You should always, always, always read the MD&A section of the 10K. There's an MD&A section and a 10Q as well. This is where you kind of get behind the numbers and start to understand what's going on with the business. Any questions on this? And people always say MD&A. Nobody says Management's Discussion and Analysis, so memorize the term as well. Following that will usually be the financial statements, income statement, balance sheet, cash flow statements, as well as notes to the financials. Okay, the notes are where they talk a little more in detail, kind of about the accounting processes and procedures the company uses, talk about significant accounts. All right, there'll be usually detail on company's debt, something that we usually tend to look at. So how much debt do they have? How is that broken out across different pieces of debt? Is it bank debt? Is it capital leases? That'll usually be distinguished in that footnote. There might also be some discussion of those non-recurring charges as well. Okay, there might be you might even see those non-recurring charges appear directly in the financial statements themselves. But a lot of times they're lumped in, they're combined into another category in the financials. So you want to kind of read the MD&A, the financials, and the notes all together to figure out where those non-recurrings exist. Okay, any acquisitions, real important, warrants and stock options outstanding. We're going to talk about stock options tomorrow and how they affect dilution and how they affect valuation. So we find those at the back of companies' notes to the financials. They usually calculate something called EPS, earnings per share. They'll break that calculation out, and sometimes they'll provide financial information on a business segment by business segment basis. They might have a US division, they might have an international division, they might have a food division, they might have a ketchup division. However they organize themselves, they may give you those breakouts in the notes to the financials. And then typically toward the end, oftentimes at the very end, there'll be a list of exhibits. Okay, these will usually be things like key agreements the company has in place, oftentimes key agreements with its creditors, with its bank, to the extent they've got any purchase and sale or merger agreements or shareholder agreements, sometimes management contracts, articles of incorporation, those types of things. They might be attached to the 10K, they might just be incorporated by reference. Right? And it would tell you where to go find that document if you wanted to read it. And you could go search the SEC filings and basically dig that out. Okay, let's talk a little bit about the financial statements. Again, this is probably going to be, in some cases, review for a lot of folks. But before we get into valuation, and especially before we start building financial models, I want to make sure everybody understands what's included in a balance sheet, what's included in a financial, in an income statement, cash flow, et cetera. All right. So when we talk about financials, again, always read the MD&A, always read the notes. Obviously, you'll look at the statements themselves. You'll put those into Excel. You'll spread those statements. All right. And really important, and as you get more experience, you'll get better and better at this, but consider the type of company you're analyzing. Okay. Wholesalers, retailers, financial institutions, different companies in different industries have different ways of measuring their business. Okay, so for example, gross profits, really important in a manufacturing context, not so meaningful for a financial services company. Okay, so you'll see differences in the financial statements, differences in the accounting, differences in the metrics they like to use often. Okay, retailers, you'll commonly hear something called same-store sales. So in other words, for stores that have been open for at least a year, how are the sales in those stores? Okay, not so meaningful in the case of a manufacturer that doesn't have stores. Okay, so you'll start to pick up on these as you see more and more different companies, especially if you go work in an industry group within an investment bank or an industry-focused PE fund, you'll see those differences as well. So let's talk a little bit about the balance sheet. When we look at a balance sheet is meant to give basically an assessment of a company's financial condition at a single point in time. All right, an income statement would cover a period of time, a range of dates, maybe a full year, maybe 3 months, maybe 6 months. But the balance sheet is always at the end of that period. It's that one moment in time. So the balance sheet as of December 31st, 2008, for example. Okay. It basically tells us how much does the company have on its balance sheet in terms of its assets. That's what we call oftentimes the left side of the balance sheet. And then on the right side of the balance sheet, how are those assets financed? Usually broken out between liabilities, stockholders' equity. Okay, so typical balance sheet, left side, we're going to have our assets listed in terms of liquidity. All right, so the most liquid item is listed first. What would that be? Cash. Cash is by definition the most liquid item. You might have something called AR, accounts receivable. Okay, that is amounts that the company's customers owe to it. You might have inventories. Probably all know what inventories are. You might have things like prepaid expenses. What would be a prepaid expense? Insurance. You might pay the premium for the year, expect to get a benefit for that over the next year. You might prepay our rent, those types of things. All right, so these would be our current assets, assets we expect to convert to cash within a year, basically. Okay, then we'd have longer term assets. We might have something called PP&E. What's that? Yeah, plant, property, and equipment, fixed assets. Desks, chairs, tables, delivery trucks, buildings, land, those types of things. Our manufacturing facilities, our machinery, all those items. And then we might have some intangibles. And every balance sheet's not going to look